Welcome back. You're watching Your World at 10. Now, yesterday, rates of certificates of deposits, that's CDs, crashed from about 7% earlier in the week to 6.1%. This has led many to believe that finally we have that downturn or decline in interest rates come our way. Today, after yesterday's decline in CDs, we had a couple of banks come in and cut their deposit rates. And in fact, IDBI also cut its prime lending rates. So, our rates finally headed downwards. I have with me A.K. Purwar, Chairman of India Venture Advisors, a veteran banker, the former Chairman of the State Bank of India as well. And I have with me in the studio here Lata Venkatesh, our banking editor. Mr. Purwar, there were two problems with rates going down. One was that banks complained that their cost of deposits was very high. And B, it was the government borrowing program that was keeping rates hard. With costs of deposits finally declining, do you believe that we are set for sharp declines in interest rates, both borrowing as well as lending?
You see, if you see the current inflation rates, which are hovering around 0.3%, and the constant signals which have been coming from RBI as far as the reduction in the various rates, repo and reverse repo rates are concerned, I feel that, well, the interest rate, reduction in the interest rates on the bank sides is now becoming literally a little overdue. I personally believe that the interest rates are headed downward. And a correction is due. Whether major or minor, only time will say.
Lata, let me put the same question to you. I think for a long time now, across the banking industry, they're saying that a correction is due, rates are headed downwards. But when are we finally going to hit that downward decline in rates?
Well, I think for the moment at least, it looks like those bankers who have been holding out are going to look a little red in the face, because the telltale signs are there. Look at the industrial output numbers. It's dismal. Right. A contraction of 1.2%, and probably the third month when we are seeing flat to negative industrial output. And credit offtake, loan offtake has gone down to 17% average annual rate. Mm-hmm. If you only took the last quarter, it would be much more miserable. It would be a contraction in some weeks and months. The writing is on the wall. People are not going to borrow at these levels. One, because there's no demand for their goods. And at this rates, people
and yet we're not seeing sharper cuts in lending rates.
Well, we have seen some kind of sharp cuts coming from, say, a Punjab National Bank, a BOB and a BOI. And, to be fair to them, probably after looking at these CD rates, they will follow up with lower lending rates for sure. Because as the CD rates come down to 6%, a 10-year HDFC paper or 10-year L&T paper is also now coming down to under 9%. So a bank is not going to be able to lend them at 10% because they can borrow from the market at 9%, even 10 years. When 5 years, they could borrow even cheaper. So banks will per force have to bring down the lending rates to AAA companies. And when you know that you can't palm off your high-cost deposits anywhere, you will be forced to bring your deposit rates down. So those who are resisting, and I bring even SBI in this, SBI has cut rates today, but it still has an 8.25 bucket.
Right.
It still has 7.75 for an annual rate, when banks much smaller than them are giving you at 7.5. It really beats logic. I don't know what they are holding out against, but when the writing is on the wall...
Let me ask Mr. Purwar what they're holding out against. Mr. Purwar, what is it? What will it take for banks to finally be able to pass on lower rates?
You see, the problem with the various banks today, which I find very interestingly, is that the deposits which they have contracted in the old time, they have contracted at a very high rate. Still, if you see the deposit rates of the entire banking system, it's still very high. And my feeling is that, well, unless and until they bring down the cost of funds, that is cost of deposits basically, they can't significantly reduce the interest rates.
How much longer do you think, Mr. Purwar, in the backdrop of the fact that we saw CD rates crash, we are finally seeing more deposit rate cuts come in today, how much longer do you think will it take for banks to be able to balance out that cost of deposits and be able to pass on lower rates both on the deposit and the lending front?
You see, I would put it this way, that there is one important thing which we are missing. If you see if you analyze the credit growth of the various banks, the sub-PLR portion of lending is now going up very significantly. What does it mean? It means that good quality customers, AAA rated customers have started commanding lower interest rates, and banks, to meet their credit requirements and to have good quality lending portfolio, are per force required to bring down the interest rates. So a major correction as far as good quality borrowers is concerned has already started taking place. But my feeling is that this is not sufficient. It has to go down further. And CD rate is one indication, but I would say it is not such a significant indication. What is an important indication is the sub-PLR lending. And my belief is now a correction, major correction is overdue. Whether it will take place before the election or after the election, that's a bet we can take.
All right. So, Lata, as Mr. Purwar is pointing out, that the sub-PLR category of corporates, the guys who are AAA rated, are getting decent rates if they ask for it. You spoke of how corporate bonds are now, or being able to raise money via bonds has become cheaper for companies. Then is it that we can't see it, but lower rates have been transferred to this economy, especially for those corporates that have the ratings to go for it?
Oh, absolutely. I mean, the market will have its way, and quality will have its way. In tough times, the men will always show off from the boys, and that's what's happening. AAA companies will be able to command. But I'm not so confident about this getting spread over that easily. It will still come stumbling with a lot of hurdles. And that's because of the basic monopolistic structure and rigidities in the system. SBI is a heavyweight, and if they choose, they can hold out for long and not pull down rates. I mean, they can afford to wait. And they're probably pricing in a lot of their old problems. Maybe their NPAs are higher. I mean, a lot of things are getting washed out or hidden because, they are a heavyweight. And likewise, they don't have private sector competition. Last time around in 2002, when rates were falling, there was an aggressive ICICI coming behind them.
Now
that competition is lost.
That retail lending
Likewise,
market.
foreign lending. There is no competition, so they're getting away with this kind of monopoly pricing power, but they can't do that for long. It'll be late, but it'll have to happen.
All right, we're still a few months away from actually seeing sharp declines in interest rates. Lata, Mr. Purwar, thank you very much for joining in.